Everyone, David Moore with Equity Advantage, and we are excited to kick the year off. It's 10 o'clock. Going to start and be very punctual getting going here. And first off, I want to thank you once again, David Moore, Equity Advantage. Thank you so much for joining us today. And this is the first presentation of the year. First time I've done this presentation. I am probably a little bit overconfident in my ability to get through this stuff. So I will just warn you straight up, probably run a little bit long. And also, if you're here with no 1031 experience, you may find yourself a little lost. This class is more about different issues that are coming up that we're working with in the marketplace these days. It's less about how to do an exchange, more about different fine nuances with respect to financing of properties. We can talk about basis gain, talk about different ways of acquiring things, talking about using different sources of money to get deals done. So if you are in Oregon and you want to receive continuing education, if you're a real estate broker, you can reach out to C Moore, C-M-O-O-R-E at 1031exchange.com. Also, with respect to questions on this, probably you're not going to be addressing any during the class. If you've got questions on the content today, or if you've got suggestions for content going forward, please let us know. We're always happy to hear ideas and provide you content that's going to be applicable in your scenario, whether you're a professional, an investor, or you're just sort of curious about what's going on there. We've got a very robust YouTube channel. So both for our IRA investors and our 1031 investors, and you can look in on our YouTube channels for content on a whole variety of issues, not just 1031 related. If you're looking at Equity Advantage, there's everything from selling life insurance contracts, cost segregation, different DST topics, institutional ticks, a whole bunch of things there that you may or may not have interest in, but it'll help fill some of that gray matter. And the same thing can be said for our IRA channel on YouTube. So without further ado, we're going to get going. Today's title is 1031 Exchanges in 2026. It is a result. This presentation is sort of a result of transactions we're working with, or we've been working with in the last couple months, things that we see coming on with 2026. I think we're all in a situation where we're optimistic about what's happening here. And our DST, deferred Delaware Statutory Trust clients, is going to say deferred sales trust, not them so much, but anyway, Delaware Statutory Trust investors, institutional TIC people, pretty much everyone involved with investment real estate in the large Wall Street context is very optimistic about where we're headed. So here we go. First thing I'm going to say is stop, okay? Before you buy or sell anything, before you close anything, 1031 is over 100 years old at this point. And even though it's so old and people are pretty familiar with it, things still get done incorrectly. If you close a transaction, whether a sale or a purchase, and you intend to do an exchange, if it's not structured prior to the closing, you are stuck. So I'm going to say that again. On a sale, if you have actual or constructive receipt of the funds, you've got tax exposure. On a purchase, let's say you've got a sale, you've done your planning and you've got a sale set, you've got a purchase set, so you don't have to worry about 1031's 45 and 180-day timelines. And then something happens on the sale and you think, well, gee, I'm just going to go ahead and buy the property I want. When I have a sale in the future, I'll structure the reverse exchange. You cannot do that. You cannot have ownership of the new and old property simultaneously in a reverse exchange. So whether a sale is being exercised or a purchase, make sure if you want to do an exchange that you have, I would say first off, don't rely on the boilerplate in state forms. So if you look at a cooperation provision, ideally in a 1031 tax deferred exchange, you're going to have something in that purchase sale agreement stating it's your intent to do an exchange. Now, if you're not sure you're going to do it, then you can sort of rely on the boilerplate that are in the state forms. And what I mean by that boilerplate is the contracts are assignable, and they've got verbiage in those purchase sale agreements in the state forms that allow a buyer seller to do an exchange. So it says the buyer seller has the right or the option to do an exchange, but it does not tell anyone that you are doing it. So if your intent is purely to do an exchange, I want to sort of stress that you should put something in there additionally stating it is the seller's intent, if it's on the sales side, to do a 1031 tax deferred exchange. On the buy side, you put something similar on that. And that way escrow knows what's going on, and they're going to ask you before you close anything, because as I said, if it's closed, we can't go back and fix it, whether it's a purchase via a failed delayed into a reverse or a delayed exchange. We need to make sure that before you close anything, it is structured as an exchange if that's what your intent is. So if you're interested in working with us on different things, my brother Tom and I founded Equity Advantage in 1991. It was a result of our own needs to have 1031 services available for transactions we were working on at the time. We found that there weren't much in the way of 1031 services in the Northwest. Actually, nationally at that point, 1991, there wasn't that much. But so we put Equity Advantage together in 1991. We put IRA Advantage together to accommodate, really our 1031 investors wanted to have more money available to go out and buy real estate. So they kept asking us about using IRA 401k funds to go do those things. And so we put IRA Advantage together in the mid 2000s to accommodate their needs. And that business today handles everything from what's called rollover business startups, which are very popular and sort of in recessionary times. If you've lost a job, you're looking for that olive branch to your future, a rollover business startup might be the tool to get you there. We do basic self-directed IRAs. We do what's called checkbook IRA or IRA LLCs. We also do 401k plans for people that are in need of those things. So if you're a real estate broker, you're looking for the ideal investment tool for your retirement, I would say a solo 401k is perfect. It's wonderful, and that's another class, another conversation. But just be aware that whether you're looking at tax money, we can help you via 1031 with Equity Advantage. If you're using qualified money on things, or you've just got questions on it, give us a call through IRA Advantage. We're happy to help out. Death and taxes. All right, this is something that there's two sureties in life: death and taxes. And I always laugh about this because I said 1031 can be the solution to taxes, while not doing a 1031 can be the cause of death, sort of. But if you think about these things, there's something called a swap till you drop. All right, and in that situation, the wonderful thing about swapping till you drop is people will come to say, well, gee, I'm going to have to pay the tax at some point anyway. Why not pay it today? And really, the answer to that question is very, very simple. What are you going to do with the money? If you want to take the money and go out and buy more real estate, why would you pay the tax? Why wouldn't you keep your equity intact? Every dollar you save maybe gets you 3 or 4 more to go reinvest. And we've got many clients that are going to exchange. When they pass away, they become an angel. Their heirs get a stepped up basis, current market value. They could sell the property the next day with no tax consequence. So that's swapping till you drop, and that's a great tool for those people that just are really adverse to paying any tax. Now, if you're just doing an exchange to avoid tax, I would question that. I would say, look, take a look before anything closes, understand what the tax liability is going to be, and then you can make the decision on what you want to do and where you want to go on this stuff. 1031 is not always the right thing for people, and that's why if you look at our YouTube channel, like I said earlier, there's a variety of topics there that are going to cover a variety of different end games too, and there's actually a couple classes on there called 1031 end games. Which will give you a variety of different things, everything from just using a basic installment sale to handling the DSTs, institutional ticks, big box single tenant stuff, whatever that might look like. QOZs, qualified opportunity zones, they can be a solution for people. So 721 UPREITs are another wonderful, I think, tool that sort of takes the downside of an installment sale and potential failure of a buyer or unforeseen accelerations upon payments, or let's say having a note just assigned to somebody else. So you got to really control what's going on there. We have a page we're going to talk about seller finance and exchange. So we're going to cover that topic ad nauseum in a little while, but just sort of a heads up on what's there. So when we're looking at death and taxes, the sure thing is we're all going to end up angel at some point. But as far as the tax liability, it's not inevitable that you have to pay these taxes through that swap till you drop situation. You can defer your gains, and at least the way the laws are today, and for future context, it's January of 2026. We still have the stepped up basis in place, and that's a great end game for people. So what is gain? What are we talking about? Why do we even care about 1031? All right, 1031 really, it's a tool to keep your money yours. And as I said a few minutes ago, every dollar you save, you got 3 or 4 maybe to reinvest. First thing I'm going to tell you to do anytime you contemplate sales, talk to your tax people, understand what the tax liability is going to be on a disposition. Then you can make that intelligent decision whether the exchange is going to make sense for you. Gain has nothing to do with profit. All right, if we look at, let's say, pre-2017, we used to do lots of exchanges of everything from businesses to, we did artwork, we did lots of collectible cars, aircraft, helicopters, all that stuff. Now, if we're talking about airplanes and helicopters and things like that, rarely do those things go up in value. Now, we did have sort of a rare situation where we did a lot of work with Hillsborough Aviation in those days, and they sold some Bell helicopters that actually the wait list to get one was so long that people would actually make money on them, increase in value there. But typically gain on those assets is driven by depreciation recapture. When we're looking at real estate, we're looking at a combination of appreciation and depreciation. But gain has nothing to do with profit. It's simply a tax calculation. Gain is the adjusted sales price minus the basis on a property. The basis on a property is what you paid for it, plus the capital improvements minus the depreciation. Now, that sounds pretty simple, but we've had people, and if you've watched my presentations in the past, you've probably heard me say, I mean, one of the transactions I'll never forget, this probably 25 years ago now, we were handling a transaction for somebody that had absolutely no idea what their basis was. Said, well, how did you get the property? Well, I got it from my incarcerated husband. Well, where did he get it? Well, he got it from his incarcerated buddy, and nobody had any idea what those numbers were initially going forward. But typically, we're looking at the purchase price, capital improvements minus depreciation. Now, the purchase price gets skewed based upon how you got the property. Now, if you just pull money out of your pocket to go buy the property, that is the quote unquote purchase price. If you bought the property via section, let's say 1034, the old residential rollover that was in place prior to 1997, that was the basis carry forward calculation. 1031's basis carry forward. 1033 involuntary conversion, basis carry forward. So those things all impact the quote unquote purchase price. Now, if, as I just covered, if I passed away and let's say my daughter Cece inherits a property from me, she'd get that stepped up basis. If I gave her a property, now her basis is going to be what mine was. So depending on how you got it, that quote unquote purchase price varies dramatically. Then we have to look at the improvements. And during the time you've owned a property, you're always doing work to it. All right. Now, one of the arguments, so every few years, every time I used to joke using one of the terms my father-in-law used to say is, knotheads. So anytime a group of new knotheads gets elected to, our Congress, they come up with the idea, oh yeah, we're going to get rid of 1031, raise all this tax revenue because we're going to get all that lost capital gain. Well, year after year, term after term, we have to go back and prove to them that every real estate transaction that happens, you think about the normal income tax it's paid. So yeah, they would lose that capital gains tax on that disposition. People are not going to pay that stuff. So it's going to decrease the market velocity, slow everything down. You think about one real estate deal and who's getting paid there. We got brokers getting paid, appraisers getting paid, inspectors getting paid, escrows getting paid, finance people getting paid, Home Depot's getting paid, the contractors, everything else that's going on. Now, the other thing that people don't understand is you start looking at, the whole big buzzword of affordable, housing these days. And, anyone involved with development understands what it costs to get a shovel in the ground and how long it takes to do that these days. But when we start looking at affordability and affordable housing, usually it's like that BC property. And imagine what happens. We can all drive down a road and see a property that clearly is unwanted or just not able to be afforded by that current owner. Now, every time a property changes hands, think about the last time, if you're a broker, the last time you were involved with a transaction where that buyer did not improve that property. So 1031 really is one of those tools that keeps the market moving, keeps properties freshened, and just really helps out in the general condition of real estate. And if you eliminate that market velocity, what happens to those properties? Like I said, we've all driven by properties that are clearly unkept, and you got to ask, well, why is it unkept? And I would say, think about, if you're a broker, think about what you're using, or if you're an investor, think about that property you drove by and you're going over and over again, gee, I wonder what they're doing with it. I would like to buy that thing. Well, if you just ask them to buy it, you're asking them for something. Are they going to move along with you? Now, if you give them a place to go, so maybe you're approaching them and say, hey, gee, I noticed you've got this property, the thing's, looks like it needs a little help, looks like maybe you're tired of it, blah, blah, blah. Give them a place to go. And that could be either, some other passive investment you might have for them, or it could be a Delaware statutory trust property, institutional TIC, anything like, maybe the QOZ, qualified opportunity zone's the right tool. Maybe an installment sale is, but give them an option, a place to go, and maybe they're going to be more likely to give up that property that they clearly don't want or can't afford to have at this point in time. But when we look at these things, the first question is, what's the tax liability on a disposition? Do I want to pay that, or do I want to do the exchange? And when we look at improvements, every dollar you're putting into a property, it's either going to be capitalized or expensed. If you capitalize it, increases the basis. If you expense it, it's just written off in a given year. So understand, when you buy something, keep receipts for everything you're doing, and work with good tax people. And let me just say this, I think good tax people are probably the most important people in your life these days. But work with people that you're going to get an answer from, not that are going to learn on your behalf. So I think it's really important working with a great team of people, good tax people, good legal people, great brokers, great escrow officers, finance people. Everyone's got a job, let them do their job. And it's a complicated world these days. Depreciation is sort of the last piece on this basis calculation. Now, you've got to understand, I had this conversation yesterday with somebody. So, well, gee, we moved out of our house and we've been renting it now, and I wasn't going to take depreciation, but now I think I'm going to. I said, well, you know what? It's really not up to you. Whether you get the benefit of depreciation is up to you, but whether you get it or not, the government's position on depreciation is you should have taken it, therefore you did. So it's really important that if you've got income properties, you're renting those things out, you've got somebody you're working with to take that depreciation on that thing. Now, understand that depreciation is one of those things. Think about the people in your life, once again, paying somebody that knows versus paying somebody to learn. Think about, in the most basic context, if you buy a rental property, let's just say it's a rental house. Typically, you're going to write the improvements off over 27.5 years. Let me ask you this, what are the improvements worth? And if you jack up the value of the improvements, what does that do for depreciation versus, and ultimately the ROI, return on investment, versus decreasing the value of the improvements? I will tell you straight up, increasing the value of improvements gives you more depreciation, ultimately converts to more return on investment, or a better return on investment. Well, what is cost segregation? Cost segregation is, sort of that depreciation on steroids, because typically we're looking at dirt and improvements. Who puts the number on the improvements? And like I said, whether you jack that number up or down, how's that affect the ROI? But you don't just look, when is anybody says, hey, gee, I'm just going to look at the tax list? When was the last time you looked at a tax list, or not tax list, but that tax statement where the numbers were remotely accurate? So you want to work with good tax people. You're going to put a number on there that makes sense. It's going to help you get where you need to go. If you're looking at institutional properties, understand they're using cost segregation typically, which is, instead of just taking, let's say if it's an apartment building, instead of just going dirt and improvements, writing off the improvements over 27.5, they're going to take the plumbing, the electrical, all those things, and you're going to have maybe 200 different components of different depreciation schedules. And so you're really accelerating the depreciation on that thing, which changes the entire ROI on that property or set of properties. Just be aware of those things. Now, back to my initial statement on basis and gain having nothing to do with profits. There's something called phantom gain. And during recessionary times, during the last meltdown, we had lots of people that were subject to this phantom gain. What is phantom gain? In a short sale or a foreclosure, the government is going to treat the debt on the property as the quote unquote sales price. If the debt is in excess of your basis, that difference is the gain. So normally we're just looking at the adjusted sales price minus the basis, and that's going to give you the gain number. In a phantom gain situation, we're looking at the debt on the property and subtracting the basis, and that difference is going to be quote unquote phantom gain. And what was really interesting is that we had a lot of people coming to us and saying, well, gee, I'm losing this property. If they were referred into us, we had the opportunity to talk to them. If they weren't, then we didn't have the ability to have this conversation in advance of foreclosure, let's say. But this was something that was a very rude awakening, because if we look at the tax consequence on a sale or a foreclosure, now on a foreclosure on a primary residence, you've got tax relief. As far as any tax relief on not institutional, but investment property, you don't have that. So you're really looking at a situation where you could be the top tax rates for a lot of our people. You're looking at 37%, or actually we're looking at 37 is normal income. So if it's under a year and you're looking at something that under a year, you're looking at normal income tax, could be as much as 37%. If we're looking at long-term capital gains, and that's Fed, stayed on top of it. If we're looking at long-term capital gains tax consequences, gains for a sale where property's been held for investment for in excess of a year, now you're looking at 20% Fed on appreciation, 25% Fed on depreciation recapture. Then each state's going to have a different rate. I'm talking to you from Oregon today, and our top rate's roughly 10% at this point, and then you can have another 3.8 on top. So you do the math. You got 20 or 25 plus maybe another 10, another 3.8. You get up where you're paying a lot, and that's assuming, like I said, it's long-term gain, something held for investment. And so you could be in a situation where you're maybe paying 40% tax in a foreclosure on that phantom gain, or you would have a choice of doing an exchange into let's say a zero coupon Delaware statutory trust, which might be 80 or 85% loan to value. Maybe it's 75%. And people are saying, well, gee, I don't have the money to come out of pocket 20, 25% to get the zero coupon thing. To do the exchange, and by the way, I'm not getting money, so how do I do an exchange? You don't get any money. Well, we're isolating you from actual or constructive receipt, not of the cash received via the disposition, but in that situation from debt relief. So it's really sort of a funky thing, because we don't get any money in those deals. We are actually put in ownership pre-foreclosure. That transfer starts at 45 and 180. When the property's foreclosed, it's ours. But in that situation, you have a choice of paying, hey, I'm going to lose maybe 40%. I got to pay 4 of every 10 and gain to the government to get nothing, or I can come out of pocket 2 of every 10 and go get that zero coupon. So we did a lot of those transactions during that recessionary period. And I'm just throwing this out there for people that might be in that situation now, or if we go into that, that's something to be aware of. Few tax codes to consider. All right. Now, 1031. That's what we're here talking about today. Applies to sale of real property that's been held for investment pre-2017. Like I said, we used to do personal property transactions too. We can no longer do that. So if you're selling personal property, you can look at full expensing of the replacement, whatever you're going to buy, if it's a business or some personal property, or maybe you're looking at a qualified opportunity zone type situation, might mitigate some of the tax consequence for you. But talk to your tax people. Once again, 1033 applies to property that's been condemned or involuntary converted. So let's say you own a property and city, state, somebody comes to you and says, hey, we're going to take the property and we're going to pay you X for it. We've had people that have sort of entered into these transactions in contemplating 1031. I would say if it's condemnation, you want to use 1033. There's a variety of benefits of 1033. One is the biggest headache with any 1031 is time, right? You've only got 45 days from settlement to ID what you want to buy, 180 days to get that property closed, or 180 days with the due date of tax return. So just be aware of that. And by the way, if you closed a deal late year, do not file your return until you have completed your exchange. So if you started an exchange in the fall of 2025, and now we're in a situation where you are contemplating putting a tax return together, filing it, do not file that thing unless you're filing for an extension until you've completed the exchange. Because if you file, you've torpedoed the transaction if you haven't completed it. So just be aware of that. But 1033 is going to give you 2 years from the due date of the tax return instead of the 45,180. That's huge, right? And you don't have to spend all your equity. So, and you don't need us. Here I am talking myself out of business. But 1031, you got to have structured pre-transact. 1033 is going to give you a variety of benefits there. You don't need us for that, but you got questions on that, give us a jingle. 1034, why do I bring that up? I bring that up because so many people today still think that 1034 applies. 1034 applied to the sale of a primary residence prior to 1997. And basically, when you sold that property, you had 2 years to buy a new property of equal or greater value. You had a one-time lifetime exclusion of $125,000 if you're 55 or older. That is gone. It was replaced with Section 121, the next one down, in 1997. Now, in 1997, 121's 250 or 500 exclusion really meant something, and it was better than 1034 at that point in time. But think about what a property cost you in 1997, and now fast forward to 2026, and you might have a situation where that 250 or 500 doesn't cover anything. So we've got lots of people that will look at that, and this is once again why, whether you're selling a home or losing a property to 1033, or you're selling an investment property, contemplating the sale of investment property, talk to your tax people, understand the tax liability, then you can move forward. You know, we can do an exchange anytime up until close. We can't do it after you've closed, but I'm going to tell you, for tax planning purposes, you want to sort of think about all this stuff immediately upon, you know, that decision to sell or the contemplation of a sale. Understand the tax liability, understand what you're looking at, understand what you're selling. Is it your investment property at that point? How long have you owned it? What's the benefit? Maybe you owned it 11 months and you're looking at normal income tax versus 13 months. Now you're looking at long-term capital gains tax. That just couple days difference can make a big difference to your tax consequence, and that's where that planning comes in. And I'm going to tell you, like I said a few minutes ago, I think tax people are some of the most important people in your life, and use them to plan these things. Don't use them just to file your return. And if you've got income properties, you really owe it to yourself to get good tax people out there. All right. Section 453, that talks about the tax treatment of an installment sale. All right, now we're going to talk about seller finance. We're going to talk about the tax consequences of it, but I'm just going to tell you, one, if you carry paper, it is yours. It's not the buyer's. So don't let the buyer's nice lawyer draw that note up for you or a contract up for you. Have your tax and legal people look at it, draw it up to the terms that you want. Understand what it means. If you're doing it as an end game and you want to have income over a period of time, maybe you want 10 years of income on that thing, do not sign a note that has without an acceleration provision. It's got to have something in there making it work for you. Blind assumptions is another thing that I've got a real problem with. You know, so we've got this nice buyer's lawyer draws up the paper, you sign selling the thing per that document, and it's got blind assumptions. So you qualified that initial buyer as your buyer, but now they're just flipping the property and now they're selling. You've now volunteered to finance that purchase for Joe Blow down the street you didn't know anything about. So make sure that you've got something in there talking about assumptions and accelerations of those things, because it's your paper and it's only going to do what you want to do. Now also make sure that if you're doing this in an end game, you're getting enough of a down payment to cover all the closing costs, plus any tax on depreciation recapture and any debt relief that may happen at that point in time. Those are two things that come up and bite people because they think they're just going to pay tax on the principal payments, long-term, you know, tax on principal payments that come in, and then normal income tax on the interest. But they don't think about the fact if they've got debt on the property, they've got tax exposure on debt relief in the year of disposition, and you know they've got that depreciation that's going to be there too. So unencumbered dirt, you don't have those two issues to worry about, but most people have improved property. You've got some depreciation there, and if you got debt, you've got some debt relief that could occur. Finally, 721. 721 applies to property that's contributed to a REIT. It's called an UPREIT, and we see a lot of these things And more actually. We've got a couple of regional companies that are using 721 to absorb. Let's say you got a property, you don't want to go through this, the exercise of selling it, and you'd like to be part of their UPREIT. You can work with them and basically contribute your property to them. Now you have a piece of a whole bunch of properties through the REIT. Now 721 UPREIT's a neat thing. I sort of look at it as the ultimate installment sale, but you have to understand that as soon as you've had your real property interest converted into shares of that real estate investment trust, that's a dead end for you. There's no tax on that roll, but there's no way out going forward via 1031. So you're going to pay tax on any future sale of those REIT shares. But those are just a few tax codes we work with regularly in here and things to be aware of. Excuse, these next 6 issues come up all the time, right? And they're fallacies in our exchange world. And the biggest one I guess would say is like kind. Like kind does not mean house for house, land for land. It never has. Like kind refers to the nature of the investment rather than the form. Now 1033 on that previous page, we talked about 1033 and involuntary conversion. Depending on why the property is being converted, if it's being converted via condemnation, it's going to have the same like kind requirement as 1031. If that conversion is due to some criminal act or fire or something like that, then you're going to have a true like kind, similar in service and use on 1033, where 1031 is just the nature of the investments. You can go from land into apartments into industrial, any of those things going to work. You can go into those Delaware statutory trusts or institutional TICs, all those things would be of like kind too. Second, 1031 does not require 2-year hold or a 5-year hold or any specific hold. So the idea is that your intent is much, much, much more important than actual time. So when you buy something, if there's some unforeseen circumstances, a la, let's say COVID, for example, and you were one of those people that bought that property and all of a sudden, in our state, the governor says, gee, the tenant no longer has to pay you, and you're going looking at that property going, hey, I've still got to make the payments. I can't afford to keep this. And somebody says, well, you can't do that. You're going to lose your exchange because you just bought it. That's not true. Okay, that's an unforeseen circumstance, and you can justify a shorter hold period in that situation. We're going to talk about holds in a minute too, and some court cases and what's there. But I'm going to say that again, the only time 2 years applies in a 1031 is a related party transaction. So if I'm going to exchange properties with my brother, I've got a 2-year hold, or each of us would have to do an exchange. Each of us would have to hold our respective replacement, properties, like I said, for 2 years or longer. So it's not or, I'm sorry, I misspoke there. I guess the one thing I would say is that there is sort of some fine print there that states unless there was quote unquote no intent to avoid tax. Is 1031 avoidance or deferral? I'm going to say it's deferral. But typically we're going to say in a related party transaction, which we're going to talk about in a little bit, it is fine to sell a property to a related party in an exchange. But if you want to buy a replacement property from a related party, both of you have to be doing exchanges, and both of you have to hold your respective replacements for no less than 2 years for it to qualify. But outside of that, 1031 does not have a 2-year hold, a 1-year hold, a 5-year hold. 5 years has something to do with the conversion of a property from investment to residence and subsequent sale. So if you want to know more about that, go on our YouTube channel, type in the fallacy of the 5-year hold. You're going to see a video talking about that. 3, there's no limit to the number of properties relinquished or received in a 1031 exchange. Now, the ID rules seem to imply there are. We're going to talk about those in a few minutes, but I'm going to say this again, there's no limit to the number of properties being relinquished or received in a given exchange. Now, timelines are going to be where it's problematic. I'll never forget one of the brokers we do a lot of work with. She got into commercial investment real estate, and her first 1031 was 2 brothers, twins, exchanging out of 8 properties into a single replacement property. Getting all 8 closed prior to the acquisition was going to be impossible. So what happened is anything that sold before the purchase came in via delayed exchange, and then we took the stragglers, those that yet have sold, we took the money from those via a reverse into that replacement. So we combined a delayed exchange and a reverse exchange, which gave us up to a year to get rid of everything and transfer that replacement property to them. We call that process a blended transaction or a blended exchange. So once again, no limit to the number of properties relinquished or received in an exchange. The idea rules can get cumbersome depending on what we're doing there. 4, you can carry a note trust deed or a land sale contract and do an exchange. Now, a lot of people say you can't do that. We're going to talk about that. So you can do it. That's what's important to understand at this point in time. 5, now this is something that's big at this point in time. You do not have to replace debt in an exchange. You hear people say all the time, so I got to go across or up in value, equity, and mortgage. Wrong, wrong, wrong. Value and equity, yes, those numbers are net of closing costs. But as far as the debt can go away 2 ways. One, by adding cash. The other is by going down in value. Adding cash to offset the reduction in mortgage is fine. There's no tax on that. Going down in value does trigger tax exposure. 1031 is not all or nothing. So every dollar you spend over your basis on a replacement represents tax deferred gain. I never make any decisions or assumptions with respect to where an exchange makes sense or ceases to make sense for clients. I've had people that will flat out refuse to pay tax of $5,000. I've got people that say, well, gee, the tax hits $1 million. I don't really care. So it's purely up to that individual and what they're going to do. Finally, we've got 1031. It's not all or nothing. And like I said, every dollar spent over the basis represents tax deferred gain. Next question, like I said, how long is long enough? And I said, we're going to get this page. And this is a situation where this Racine case, we had a property. If you ask me, I'm going to tell you a year. Okay, I'm going to tell you a year as a whole for 2 reasons. One, it's been proposed several times, and 2, the break between short and long-term tax rates on assets held for investment. I think it's pretty clear that's where the government would like to see, but it has much more to do with what you're doing with the property than time. You're flipping properties. You think you're an investor, you're not. You're a dealer, you're paying normal income tax. I don't care how long it takes you to quote unquote fix and flip that property. It could take you 2 years, but if all you did was bought it and you're working on it, upon completion of the improvements, you sell it, you're a dealer, it does not qualify for 1031, and you don't get long-term capital gains tax treatment on the sale of that property. So that's why anybody that flips properties sooner or later is going to figure it out. They're going to get tired of doing that, and they're going to do modified flips. And you know, I think BRRRR is, you know, a term that's sort of out there that people use these days, an acronym, but you know, buy, you know, repair, rehab, refi, and repeat, right? Okay, I'm going to take it a step further. I was taught, and this is back in the 80s, you know, mid 80s, late 80s, and early 90s, when I was buying properties, buying them, fixing them with my brother. We'd buy them, fix them up, stabilize them, do the refi. They'd be rented out for a year or 2, and then we'd do an exchange and move on. And you know, that what happens is that any given property, at some point, the equity reaches a level that no longer makes sense. Your ROI drops. So you've got a point where either you have a choice to get rid of the property or to do a cash out refi to get your leverage where you need to be and to go forward. The old saying, why would you ever sell a great piece of property? That's a great question, right? But I'm going to put it out there and just say, okay, gee, when do you decide whether the refi is correct or the exchange is correct? And I would just say, is there a reason to keep that property that you maybe you just like it? Maybe it's an area you really have faith that appreciation is going to. I was taught never to bank on appreciation. Answer 3 questions. What am I going to make? How am I going to make it? When am I going to make it? If I can't answer the questions, don't buy it. But you start looking at that return as the equity increases, the ROI decreases. And you've heard me say it before, my brother and I would be very happy on a property that we'd bought and gone through, and you know, our mentor would say, when are you getting rid of that thing? We go, what do you mean, when are we getting rid of it? He said, you can't afford to keep it. The ROI's dropped, your equity's too high. And so that refi could be in a situation where we think we can do something else to the property, increase value, or maybe we're going to bank on appreciation because of where it is, something else, where the 1031 is the tool to use if you've exhausted all those benefits and it's time to move on. So the exchange isn't always the right thing. Maybe the refi is the right thing. That's where you're going to look at your portfolio. You know what you got. You start looking at a context of the ROI, what you like, what you don't like, and where you're going to go with that stuff. But this Racine case was a situation where somebody bought a property, And we're going to talk about converting properties, why to do it. But they bought a property and converted it from, they tried to rent it, tried to lease it out, couldn't do either. And they ultimately moved into it after 4 months. They got audited, taken to court, prevailed in court after a 4-month hold. I'm not going to tell you 4 months is long enough. I'm going to tell you that, you know, a year would be ideal, just because, like I said earlier, it's been proposed a couple times, and who are we to, you know, to argue with the IRS on these things? But with that said, you buy something, maybe you're moving, maybe the property is not what you thought it was, maybe you got some other issues and you want to get rid of it, and it's under a year. Talk to your tax people about it, just understand what's there. And I'm going to tell you that there's no stated required hold in Section 1031. So when I look at an exchange, I like simple. Keep it, you know, that KISS principle, keep it simple, stupid. So 4 basic cornerstones: got to be an exchange. What's relinquished and received got to be of like kind. We have to go across or up in value and equity. I said nothing about debt, did I? We call that the napkin test. And then we have to have continuity of vesting. The person or entity that gave us that property or properties has to receive the replacement property. So we're always looking at that vesting. The biggest headache in any exchange is going to be time. The second biggest one is the vesting piece. And I'm just going to say it up front. We got a slide talking about partnership exchanges, but partnership issues always are something to consider. And if we're in a state like we are, where you're in a non-community property state, even a limited liability company with spouses as the sole members, that's a legal partnership in Oregon. It is not in California or Washington. So depending on where it is, whether it's disregarded entity or a partnership, that's important to understand when we're looking at this vesting piece. You've got a property that's pending, either purchase or sale. How do we get started? Very, very, very simple. What do we need? All we need is the client's name, address, phone number, an email address. We're going to also need the escrow officer's name, an escrow, you know, phone number, an escrow number, email address. If you don't have an escrow number, we're going to want the buyer's name, and you know, if we've got a property address, that would be great. If we're looking at a reverse transaction, we're going to need, obviously, the seller's information on that. So we don't need a lot. What we're going to do as soon as we get that information, we're going to reach out to escrow, get a copy of the purchase sale agreement and the title report. We're going to take all the parties to the purchase sale agreement, merge that information into our contracts. We're going to take the legal description off the title report and integrate that in there. And we want to, you know, obviously understand how that property is being held. Now, does a deed actually indicate ownership? No, it doesn't. I mean, imagine you buying a land sale contract. You're buying a property from me on a land sale contract. I've got title till you pay me off. There's lots of situations where we're going to be in a transaction or looking to put a transaction together, let's say, and we get started, and you know, maybe you're the broker involved, and you thought, hey, you know, this property is owned by this person or this entity, and then you get that trio, and it's something totally different. Well, you want to understand what the taxpayer's been doing. Benefits and burdens of ownership is what's going to drive ownership of that thing. So if you've enjoyed the economic benefits and burdens, you're not on title, it's quite possible you might just simply need to do a correction deed to reflect the correct ownership. Maybe you've had properties for years that were yours, you got married, and you've been filing jointly for the last decade, but that other spouse is not on title. Well, he or she's enjoyed the benefits or burdens, so you know, maybe correct that title, get them on there if you're going to have them on title to replacement property, fix it up, and that's one of those things we're going to want to know. And as I said earlier, the biggest issue with any exchange is time. The second biggest issue is the vesting. You know, in bold, the bottom of this page, if you've entertained a sale, you've got a sale pending, and maybe you've got earnest money that's gone hard, and you've put that earnest money in your pocket, You're not stuck with it in your pocket. So you've got a choice at that point. You can keep the money in your pocket. You can pay tax on that money as boot received when the property closes. On the other hand, if you don't want to pay tax on that money, just return it to escrow prior to the close, and it would be included in our contracts in the exchange, and you're going to have total deferral on that piece too. But that's one of those things that comes up a lot is, well, gee, I took the earnest money. If you spent it, you spent it. Now you obviously got tax exposure. You can't get the money back in. But if you get it back in there, you're going to be fine. This slide, there's something called 1031-G6. Now, in a market where we've got things that are not happening, or maybe you've got a transaction you put together and you decide you don't want to complete it. Maybe you were in a pinch and you had a sale pending and you had not gotten a chance to talk to your tax people yet. Now the money's with us. So when the money's gotten to the exchange company, all right, so at close, we will have already provided escrow instructions for escrow, tell them what needs to happen to have the transaction set up as an exchange. We'll have an exchange agreement that goes out, spells all the terms and conditions of the exchange. We're going to assignment agreement that actually allows us to step in, assuming all rights and obligations of the taxpayer, seller, the relinquished, and buyer of the replacement property. So with those things, we're going to get it all together, be in there. And if the money gets to us from close, it's stuck with us until day 46. So we can only let money out of the exchange after you've purchased everything you have the right to buy, which means that no time prior to the 45th day. Now you can buy something the next day, that's fine. So we can send the money out for any purchase. We just can't give it to you, even though you're going to pay tax on it, until you've purchased everything you have the right to buy. So if you're in the exchange with us, you can't get the money for any reason until day 46. If after the 46th day you plan to, just take the money, let's say you ID'd something inside the 45 and you decide, gee, I don't want to complete the exchange. Well, you have to rescind the ID, and then we can get you the money on day 46. On the other hand, if you pass that 45th day, you had an ID in place, now we can't give you the money until you've purchased everything you have the right to buy. So it's really important on day 45, you're totally committed to completing the exchange, you're going to leave the money in there. We cannot give you the money until you've purchased everything you have the right to buy, okay? So don't just flippantly put a property on day 45 just in case, because what happens if you find the property you really want on day 60? We can't give you the money until day 181 in that situation. So it's really important. And by the way, if you want to pull money out, you can pull it out at close, but it's got to be specifically excluded from the exchange. So I said it earlier, every dollar spent over your basis represents tax deferred gain. But if you said, gee, I want to pull 50 out, go take a truck, a trip or do something like that, go buy a truck, well, you can pull that out, but it has to be excluded from the exchange. So in our assignment agreement, it's going to exclude the 50K. You're going to walk out of closing with the 50. The balance of the money comes to us. After it's gotten to us, you can only get that money out after you've spent all the money on everything that you had the right to buy, which means everything you've identified. Now, identification, you can ID, let's say, if we're just going 3 properties, you can ID 3 with the right to buy 3. You could ID 3 with the right to buy 1. And I would say if you're IDing 3 to buy 3, then obviously you're going to leave that open-ended. If you're going to ID 3 to buy 1, then in our ID packet, there's a little blank that asks, okay, I'm identifying these properties. I have the right to buy X, and you put 1 in there. And as soon as you've closed out 1 and we're outside the 45, the balance of the money can get out to you. Now, if you're working with some other exchange company, say, well, gee, my exchange company they don't care. They don't follow 1031-G6. They'll just give me the money. It's called an accommodating accommodator. The problem with that is that the government has been clear on this. It's a policy and procedure issue. So you're thinking, well, gee, they'll just give me my money because I'm going to pay the tax. Well, that sounds all well and good, but the idea is that company's policies and procedures are invalid. Therefore, every exchange that company does is invalid. So you don't want to be working with somebody that's just going to give you the money and work willy-nilly with you on these things. You got to be doing things by the book. Otherwise, the exchanges themselves are not valid. This is something that comes up a lot. Now, we've got lots of people that say, maybe I'm going to, instead of going out and getting a new loan on a property to go buy this income property, I'm going to use a HELOC to do it, a home equity line of credit. And it's a great tool. It's money that's there for you for a variety of things. Maybe it costs you less. You don't have the loan costs initially there for every purchase, and you've got money, access to other money if you want to go do some other things. It's a great tool. So the HELOC can be a great tool to go buy an investment property. The problem comes up when you go to sell that income property, because a lot of times now you've owned the property, use the HELOC. That HELOC money is not debt on that income property. That is equity. So when you go full cycle on that property and you sell it, often people want to go pay the HELOC off. And you have no ability to do that because, like I said, the money used to buy that property is equity in the property. Upon a sale, 1031 requires all value and equity be met, and therefore any money coming out to pay the HELOC off is going to be taxable as boot received, and you got an issue there. So just be aware that if you're looking to get money back out of something to take care of the HELOC, maybe you're going to have to do a cash out refi of that property pre-disposition, and I would do it well before you ever put the property on the market. Otherwise, it could be looked at as a step transaction, which leads me to this page. All right. And I said it earlier, remember I talked about that, flipping properties, not qualifying, buying, rehabbing, refining, seasoning the thing for a period of time, then doing an exchange. The refi cannot happen immediately pre-disposition, or a cash out refi cannot happen while a sale while you've got a property listed. The government's going to look at that and say it's a step transaction. You're entering the refi, cash out refi to pull money out without tax consequence. They don't like that. So a predisposition cash out refinance to go buy something or go spend money on something else, you've got to be very careful on when you do it. Talk to your tax people, make sure you're doing it early enough where your tax people are comfortable with it. If they're not comfortable with it, either don't do it or get different tax people. So really, for planning purposes, make sure if you're going to do a cash out refi predisposition, it's done well enough in advance where nobody's going to have questions in an audit that you did these things to avoid tax consequences. All right. Post-acquisition is a great way to get things done. So after the acquisition, as long as it's a separate action, you can do a cash out refi. So you complete the exchange, spending all the money, then you do a cash out refi and take that money and do what you're going to do with it. And once again, it cannot be a purchase escrow and financing closing integrated with that cash out refi. It's got to be a closing, and then at a later date, the cash out refi. And you're going, well, David, what's the difference in those two? In the refi predisposition, you've got the security instrument goes away and it's just looked at as a bad thing. Now, once again, it has to do with intent. Now, you might be in a situation where you're entertaining a reverse exchange. So you're looking at this cash out refi to get access to funds to go out and buy that property as a reverse exchange. And I'm going to tell you, in that situation, you want to paper what's being done and show your intent and show basically that property that's going away, the value and equity of it cash out refi, and then post exchange, you can show that all the refi money was put in the reverse property, and then all the net equity of that future disposition of that property being relinquished, you can track all that money. So we want to be able to track all those funds forward into replacement properties. We don't want to have any of that money going into your pocket. If it is going to your pocket, that's where you got the potential issue. If that money, the cash out refi money, is being used for a reverse exchange purchase and the balance of the equity goes forward into that or additional properties in the future, then you can track that. You can say, look, there was no intent to avoid tax. You can clearly see all the money went forth. But once again, talk to your tax people, make sure they're aware of what's going on. And reverse exchanges right now, they're just more popular right now for a variety of reasons. Maybe sales are blowing up, or maybe the opportunity to buy something is right now and the sale hasn't happened yet. But reverse exchanges are popular at this point in time. Identification of replacement properties. This is the problem. This is where people, it sort of implies that you've got a finite number of replacement properties you can do. Now, identification does not mean you've got a purchase pending. Identification just means you're giving an unambiguous description of the property or properties you intend to buy. And that could be a common address, including city, state, and zip. If you're buying a piece of a property, if you're buying a majority of it, you could say the whole thing. If you're buying a minority interest, you've got to ID the portion that you intend to buy. So you've got 3 different identification rules. And by the way, we're going to immediately upon close of your relinquished property, we're going to send out an ID packet, which gives you these rules, a form to be filled out, and you just have to return it prior to midnight the 45th day. Everybody assumes it's got to go to the exchange company. Legally speaking, it's got to go to somebody that's party to the transaction without an agency relationship. I'm going to tell you, get it to us, because the auditors come knocking and we don't have ID in your file. There's potentially going to be some issues there. So the ID rules, 3 rules, they all work independently of one another. First one says 3 properties of any value. Second one is ID more than 3. Total value of the properties ID cannot exceed 200% of the relinquished property's value. What's a property worth? Does a property have to be on the market? Is the value what it's listed for? Is the value what you're willing to pay for? That's what I would say it is, but you're looking at 200% on that. Third rule says you can ID more than 3. The value can exceed 200% of the relinquished property's value, but get closed 95% of the aggregate value of all properties ID'd. Once again, we've got some question on valuations there. I'm just going to be say be conservative on those things. But once again, a property does not have to be listed to be identified. So rule B and C, you've got value numbers to consider. That first rule, the 3 property rule, value is irrelevant. Multiple replacement properties. Now this is something to contemplate. You got 2 choices. Let's say you're selling a property and you got no debt on it. And you're thinking, well, hey, I'm going to exchange out of that property with no debt into a variety of replacement properties. Well, 1031's tax deferred. It's not tax free, and you're going forward and you're spreading that gain doesn't go away. The gain is being spread across the replacement property. So the opportunity cost of any exchange is time. You've got a sale that happens, you've got a purchase that has to happen within 180 days of that date. If you've got a reverse exchange, you might have a purchase happen. You've got 180 days from that purchase date to sell what you don't want. So we've always got that time issue that's there. Now, if you're going to take that unencumbered property, go out and buy 3, 4, 5 replacement properties, do you want to do all that? Do you want to identify all those in that 45-day timeline? Can you get them all done in 180 days total time period? But whatever you're purchasing, now you've got that low basis that's spread across all those 5 properties. Now look at option number 2, on the other hand. Think about what we just talked about with cash out refis after acquisition. So let's say instead of doing that exchange into multiple properties, you've got a property that's going away. Maybe you've got 1 or 2 replacements that are set, and maybe they satisfy the exchange. So you buy them, maybe you buy one of them outright, or maybe you buy on a short-term seller carry, and then you put permanent financing in place later that gives you access to that money. Now you've got that cash out refi money. You take that money to go buy the additional properties that you want to acquire. You've got 2 benefits with option B. 1, you've eliminated the time constraints at 1031, and 2, whatever you pay for those additional purchases using the cash out refi money, the purchase price is the basis. So you're going to have much higher basis. So you've eliminated the time and you've got more basis to write off, increasing your ROI. So anytime we've got that option, instead of going and leveraging through the exchange and all these replacement properties, if you got the ability to bury the gain into 1 or 2 replacements, maybe you're buying one, leveraging it, maybe you buy another one outright, you're taking a piece of that. But that's a whole planning issue. And I would say talk to your tax people, give us a call. We're happy to talk to you about that. But I just really like that option B for a variety of reasons. Seller finance, okay? Why is the seller finance there? That's the first thing I want to know. Is it there because it's an end game for you? And we're running up on an hour here. We've got a variety of slides left. I'm going to go through the content. There's examples at the end. And by the way, this packet, if you want this slide deck, reach out to Seymour at 1031exchange.com, and she will send you the slide deck so you can look it over. And I believe it'll probably be up on YouTube also. But anyway, when we're looking at notes and seller finance, as we said in the fallacy page, it's one of those things people, well, you can't sell and carry paper and do an exchange. No, that's wrong. You can. There's 5 different ways to get it done. But I want to know, why is it there? And if it's there because you want it as an end game, great. Make sure you've got the acceleration provision in there. Make sure you've got something on that prohibition of assumption on that thing. So So we want to make sure that if it's yours, it's going to do what you want it to do. But that's an end game. Now, on the other hand, if you're just doing it to accommodate a buyer for some reason, you got to understand the liability. And as I said, first thing you got to do is make sure you get enough of a down payment to pay the brokers involved, escrow involved. If I'm involved, I probably want to get paid too. And then also enough to cover any depreciation recapture and tax on debt relief. And those are the big things that bite people are not aware of. So if you want to do an exchange and you're selling and carrying paper, I'm going to say, one, use a note trust deed. It's a lot easier for us to work with. But what'll happen is that note comes to us along with the cash, just like the cash would in any other exchange. The note's going to be ours. We're going to be the Benny of it at close. And at that point, now we've got these different options here. We can sell the note to a third party, which I rarely ever see these days. The discounts are steep, sometimes in excess of what the tax liability is. So just be aware of that. Two, use the note to acquire a replacement property. So when we go to buy the replacement property, you look at your purchase sale agreements, doesn't say total cash paid. You're going to have sort of a variety of instruments used to make a purchase, different forms of consideration. And you would use the cash and you would use the paper as partial consideration for the purchase. And that can happen. It doesn't happen very often. I've had it happen a few times where lawyers have sort of cross-collateralized things, and that makes people more comfortable. So that is an option that's there. The third one is the one that typically happens, and our client, the taxpayer, buys the note from us, and they go, well, gee, David, it's my paper ultimately. Why am I doing that? And what you're really doing is substituting cash for the note. And why you would do that is, maybe you got a $500,000 note that you carried on that sale, and the note's paying you 7-8%, and you've got money sitting in the bank paying you 2 or 3%. Well, wouldn't you rather have the note? I've actually had people borrow money to buy the note. So what you're doing is substituting cash for the note. It allows us to then complete the transaction, the acquisition, keeping all your equity intact moving forward. So that's what I mean by purchase the note. Number 4, maybe it's a short-term note and the note's going to mature before the replacement property is acquired. So we've had a variety of these that happen. I've got an example of a big one that we did last year where the purchase financing blew up. Our guy's 180th day was going to eclipse without the purchase being done. The seller initially thought, well, gee, I don't care. I'll just walk away from the sale because they'll buy it later. And I said, no, you don't understand. This deal is dead if you don't accommodate this. So what we did is we turned that transaction around and used a short-term seller carry to get the purchase done, completing our people's exchange before the 180th days expired. The other seller, the seller of our client's upleg, became our client on their disposition. The note was ours. The permanent financing came in, took out that note, and then they were free to go complete their exchange as well. So, when people are shopping 1031 companies, often they just look at costs. I'm going to tell you, you better understand who you're working with and their experience and background in this. And my father sort of told me in life, don't assume things are always going to be going the right way. Be prepared for those inevitable sort of speed bumps in life, and we'll work with people that are going to be on that team to help you get where you want to go. And that was an example of a transaction. That seller was working with another company that didn't have in their capacity to get that deal done, and we made it happen for them. So that short-term note took care of them, got them where they wanted to go. Partial exchange, you can also just have a situation where you're going to, if the down payment is large enough and is in excess of basis, we would be in a situation where maybe the down payment is exchanged and you just take the note and pay tax on that money as it is received. So there you go, 5 different options on seller carries and with different tax consequences, but it is possible to do an exchange and have seller carry. Partnerships. So seller carries coming up a lot. We've got a lot of situations with partnership transactions these days. Lots of people that have owned properties for years. I was talking to somebody recently, just say, the baby boomers and the number of properties and number of things, estates, where you've got a whole new generation of people are going to be inheriting all these things. If it's been done right, they're going to get stepped up basis and take care of those things. But we've got a lot of people that we have worked with through the years that you might have a group of 5 people that have owned all these properties. Maybe it's 5 family members, and they've got all these properties that are owned jointly via, a family limited partnership or a limited liability company, something. And at some point, people are saying, you know what? I don't want to be partners with, family members or friends or whatever. And so we end up in a situation where one, partnership interests are not exchangeable. But we might have a portfolio of properties where we're just going to consolidate ownership. So you might say, okay, we've got 3 or 4 people, and Peter wants this property, Susie wants this, Timmy and Jackie are all going to take these respective properties. And so in that situation, what you're looking at is you're balancing the value and equity ownerships of all those properties. And you can do those transfers via assignments of membership interests in different limited liability companies. You wouldn't have to actually do exchanges. You can have a swap agreement that spells it all out and takes care of it. You don't have to actually entertain a full-blown purchase sale agreements and escrows and everything else that's going on there. So swap agreements can balance that stuff out, and that's a big tax planning exercise. We do a lot of this stuff, and we work with the taxpayers, tax and legal people to get it all sorted out, get everyone where they want to go, and those can be done via swap agreements. Now, typically what happens is we've got people that are selling properties and going different directions, and in that situation, partnership interests are specifically prohibited from exchange, so we have to drop into a tenancy in common, either pre-disposition, which is a drop and swap, or post-acquisition, which is a swap and drop. Whether you do the drop and swap or swap and drop is really going to be dictated by a variety of issues. And one of them is, do you guys get along? Do the owners get along? Do they want to, sit on it for because if we complete the transaction, you ought to hold it and season. Even though I said there's no holding periods in 1031, I would say 1 year based upon 2 factors, like I said earlier. And so I would say if you're going to do the drop and swap, it ought to be done. The drop ought to be done maybe a year pre-disposition. The problem with that is people don't think about it a year ahead. The second problem is it really requires you break the entity, you do all the deeding out, you've got different tax returns, you've got different lease agreements, you've got the loans, everything's got to be changed to reflect the tenancy and common ownership, and it just doesn't happen. So 9 times out of 10, it's happening at closing, and you've got a purchase sale agreement in place. People might say, well, we're just going to sign the PSA from the entity to the tenancy in common and then get it done. I'm going to tell you it's better to rip up that PSA and draw a new one. California, the Franchise Tax Board down there, pretty clear. They don't like to see a simple assignment. They want to see a clean sheet, a clean sheet purchase sale agreement in place there. But that should all be done well in advance. But people just don't think about it, and then just logistically it's tough, so it ends up happening quite often at close. The other option is to go forward, completing the exchange, hold the respective replacement property. Maybe we take the exchanging entity and buy 4 different replacements, all via different limited liability companies with the exchanging entity as a member. A year post-acquisition, we do assignments of membership interest to the respective owners. And that way we don't even have to draw new deeds, title policies in place. The downside of that is you're with these people that you necessarily didn't want to be with for another year, and if there was lending on those properties, you might have to work to get new loans in place to get yourself out of the guarantor position on those things. But that happens a lot. Maybe if we've got, let's say, 3 or 4 people that are in an entity, and 1 or 2 want out and 2 are going to go forward, we'll keep the entity intact for the people that want to do the exchange, and those that are going away, we'll just deed them out, tenancy in common with the entity, and go forward that way. If the entity ends up a disregarded entity, you've got a reset of ownership. So once again, that's why that predisposition situation, we're going to look at the entity. If we got multi-member entity and it's still a situation where we've got a legal partnership, then we don't have reset. If it goes from a multi-member entity, which is a legal partnership, to a disregard entity, now you've got a reset on the hold, and a seasoning period should be their predisposition on that change. But you can see where partnership issues get cumbersome. A lot of planning is important, but we've got a variety of ways to get things done, and that's a conversation we want to have with you sooner rather than later. And you can consolidate, you can buy another member's interest in a property If you're just taking money out of your pocket, you can obviously buy a membership interest in the entity. If you're wanting to exchange into their interest in the property, they would drop their partnership interest into the tenancy in common, and you have the ability then to exchange into a tenancy in common interest in a property that you already own. If you're doing that and we're in a related party transaction, and actually I'm just gonna hit it. I've got a page on related parties in a second. Let's say you want to buy a brother sister out of a property and you're doing an exchange, and this is another example I've got at the end here. You got a situation where you can buy their interest out if it's dropped in tenancy in common, but if it's a related party transaction, the only way you can buy their interest out is if they're going to do an exchange also. So it's really important for planning purposes that in a related party transaction, I said earlier, you can relinquish a property, you can sell to a related party, and without their need to do an exchange. But if you're buying from a related party, both you and they have to be doing exchanges and hold their respective replacements for no less than 2 years. So that's really important that we have a conversation over what's happening. An example that is in this packet talks about a related party transaction where they're acquiring a property from a sibling that was just going to take the money and go out and buy Wall Street stuff. And the issue with that is, because the financial advisor talking about the Wall Street said, well, hey, we're going to give you, 9% on this money. So, well, gee, is that 9% after they just lost 40% to tax? And I would love to see 9% after losing 40. So you got to look at, is that 9 net of taxes or including the taxes, right? What's going on there? But what in that transaction, what we ended up doing is saying, look, don't just sell and pay the tax and go buy the Wall Street stuff. It's going to take you forever to get up, catch up to the tax you just lost. Why don't you do a 1031 into a 721 upreit property where they're exchanging everything, taking total deferral into the Delaware Statutory Trust, which maybe a year ends up rolling into the 721. And the sort of crazy but very interesting thing about a 721 is that need to talk to your tax people, confirm all this. But when you sell these shares of the upreit, typically when you sell something and you're going to pay tax through the gain until you get the basis. Well, for some reason, 721s, you're able to sell through the basis with no tax until you get to the gain. So to instead of take the money and go buy Wall Street stuff after taking a 40% tax bath, you could do the transaction, the 1031 into the DST, rolls into the 721, sell through the basis. Now you've got pre-tax money to go buy the Wall Street stuff. So the downside of it is you're going to be waiting a year or two until that thing rolls into 721. But that's an opportunity cost. You just got to sort of look at it and understand what's there. All right. Conversion of properties. We've got lots of people that will convert investment property into residence into investment. There's reasons to do both. And I sort of alluded to it back when I hit on section 121. We've got lots of people, maybe you're working from home since COVID. Well, if you're working from home, that home office could or should be treated as a home office and you're taking tax, you're taking depreciation on it. In that situation, a sale, if you've been doing that for more than 3 out of the last 5 years, it no longer qualifies. A home office never qualifies for 121, the universal exclusion. You have to do an exchange. A duplex, half owner occupied situation where you've got one sale, allocations 1031 and 121. A home on acreage, same situation. The home is 121, the working land is 1031. A whole variety of situations where we've got both, or you can convert 121 to 1031, 1031 into 121. As far as in games, we have lots of times where we're buying property that's an investment property that's converted into a primary residence, later sold. I gave you that Resync court case where that happened after 4 months. They successfully defended it. They argued hardship. They said I couldn't rent it. I couldn't afford to keep both that replacement and my home. So that's why they successfully defended their 1031 even after 4-month hold. I would like to see longer than that, but that was good enough in that case. But the 5-year hold that's sort of alluded to in 1031 often has to do with a purchase of a property as an investment, conversion to a primary residence, a later sale attempted application of 121. If you sold a property inside 5 years of acquisition that was acquired via 1031, converted into a primary residence, a fully taxable sale, if you sell it within 5 years. After 5 years, you're going to be subject to something called the Housing Assistance Tax Act. So I'm going to say this. Do not think that you can just exchange. You got this great idea that you're going to exchange out of an investment property into a new quote unquote investment property that gets converted into your primary residence. You're going to live in it for 2 years. You're going to sell it and get rid of all your gain. That does not work. It hasn't worked since 2008 with the Housing Assistance Tax Act Obama administration put in place. So, you know, there was a period of time right after 121 got in place where you could do that, a couple of years where we were able to do that. But in 2008, that door got slammed shut. Related party transactions, we've covered this one. So once again, selling to a related party exchange is going to be fine. Buying from one is not okay unless both of you are doing exchanges and holding your respective replacement properties for no less than 2 years. Reverse exchanges, we've got that. We've got two different structures: warehouse relinquish and warehouse replacement. And you know, I'm sitting here an hour and 15 into it. It's probably got 15 left. I need to give you guys an hour and a half of C actually instead of hour. But if we're looking at this situation, we've got two different options on a reverse exchange. First thing I'm going to say, I said earlier, you cannot buy it without the other. You cannot own both the new and old property at the same time. So reverse, you've got to have the financial ability to buy the property without the relinquished selling yet. And two, you can't own the new and old at the same time. So we have two flavors of reverse exchange: warehouse replacement or parking replacement, or a warehouse relinquished. And a warehouse relinquished transaction means that we're going to take ownership. So basically, you negotiate the purchase of the replacement property. You show up at the purchase with the money required to buy that property. We sign a note saying we borrowed that money from you when and we close on that property. And when we close on it, ownership of the replacement property goes straight to you. The relinquished property is transferred to us. The exchange is effectively done at that point in time, and we've got 180 days to pay you back, for that property to go away and to pay you back the funds. Now, what happens if the property never sells? We're going to deed it back to you, and you no longer have an exchange out of it. But if it does sell, then when it sells, we're going to take the proceeds from that sale. We're going to pay back the debt we had to you. If there's funds in excess of that amount, you would then have the ability to go forward via a delayed exchange. You cannot take additional money and put it into a property you already owned. So, the benefit of a warehouse relinquished reverse exchange is that the lender is going to be happy because they're just financing you for the purchase of property, and we're not taking ownership of it. The benefit of a warehouse replacement, where we're taking ownership of the new property, is you can actually come in with a lower down payment, and then when your property sells in the future, the proceeds from that sale can be used to pay down funds in excess of the down payment, and we can bury all the money and then transfer ownership of that property to you. So once again, warehouse relinquished means we're taking ownership of the relinquished property. So we go out and buy the new one, it goes straight to you. The lender's happy, the relinquished is ours. When it sells, the proceeds come in, we take excess funds, go buy additional stuff, and we're done with that transaction. Warehouse replacement, we have the ability. The cool thing about warehouse replacement is we actually can do improvements to property too. If you want to do an improvement exchange, we can be working on the property during the time we're on ownership of that replacement property. The downside of the warehouse replacement is that if there's a loan involved, you need a lender that understands reverse exchanges and is going to allow us to take ownership, because we're going to take ownership of that property via limited liability company we're the sole member of. And then when your property sells in the future, we're going to convey ownership of that property either via assignment of membership interest in the entity, or we would deed from that entity to you completing the transaction. And there's always an up and down to each option there, and that's a conversation we would have. But that in a nutshell is how reverses work. And once again, we're going to have on a reverse 45 days from the date of acquisition to ID what properties you're relinquishing, and 180 days for those to go away. So it's just really the ID rules are the same as they are in a delayed exchange, and they get sort of screwy when we start looking at values there. But that is sort of 1031 in a nut. Reverses in a nutshell. Blended transaction, I gave you that example earlier where we've got a series of properties coming in as a delayed. We've got a series of properties coming into the same property via reverse, and we would have 180 days from the first sale to transfer the new property. Via the delayed exchange, we'd have 180 days from the acquisition date to sell those stragglers that have yet to sell and complete and consolidate both those transactions into one replacement property. Few examples. I lied. We're going to get through the examples real quick and be out of here. So if you have to go, I understand. Clients 1031 is jeopardy. This is what I was talking about. We had, this is a big deal, and we were banging up. It was like 2 weeks before the closing. The financing just kept getting kicked out, and all of a sudden we're on right about that 180th day, and it's like, this deal is not going to happen. The last effort at financing blew up, and all of a sudden we're looking at, this is millions of dollars here, and it was going to be millions in gain. So the problem was the seller initially thought, well, hey, the deal blows up, they'll just buy it anyway. And I said, no, you don't understand. Our client doesn't have the money to buy your property if they are not able to complete this transaction. And they're like, well, gee, we're doing an exchange, we can't carry paper. I said, well, no, you can. I mean, it's just got to be structured right. And the exchange company they were working with wasn't willing to do it, didn't understand exactly what needed to happen. So we got involved, worked with the seller's legal counsel, and got a note set up that allowed us to be the beneficiary of it. We took over the exchange. We did a short-term seller carry for that party. We completed our buyer's exchange inside the 180 days. They got their permanent financing in place inside the 45, and that permanent financing took out the short-term seller carry, which gave the seller the ability to then complete their purchase of their replacement. And we took, obviously a failed transaction and got everybody where they wanted to go using this structure. So don't give up, just understand that you're going to have a little complexity there, and the only dumb question is the one you don't ask. This is just an example of a variety of situations, a variety of things that you're buying, and understanding the difference between flipping property and investing in property. So these people gave up a vacation rental they'd had, ended up exchanging into tenancy in common interest in an apartment building, and then bought some single family rentals with the intent of fixing and turning them. The single family rentals were acquired for investment. They were acquired, fixed up, stabilized, refied, seasoned a year or two, and then later exchanged out of into their replacement properties. And really, you're looking at flipping property. You're a dealer. You're paying normal income tax. You don't have, I don't care how long it takes you to fix it up. You're not an investor. You think of yourself as an investor, but you're in business. And you're going to be paying normal income tax, and you're not going to have the ability to do an exchange. So just really understand that, sharpen your pen. I understand if you're getting started in investment property, you have to flip and you have to sell and you got to pay the tax. I understand that. Everyone's got to get started. But as you build that massive funds to go forward, you really got to start looking at what you're doing and understand you can go and literally do this without having to pay any tax if it's structured correctly. This is an example of one of those transactions during the last recession. The property was being foreclosed. We got a call pre-foreclosure, and this was, pretty crazy at times because we might have 20 investors in a given property, and if they were made aware of the tax consequence, the choice is pretty simple: sell or lose the property foreclosure and pay the tax up to 40% or more, or do the exchange into, in this situation, typically we're going to zero coupon DST investments. These were institutional properties, so the debt on the relinquished property was not recourse to these taxpayers, so it was not damaging their credit. But even if it did, if they're accredited investors, they have the ability to buy into the DSTs, which is non-recourse debt. And those typically were going to be at about 80% loan to value at that point in time. So pretty easy conversation to have if people are made aware of it. lose the property, pay 40% tax, or come out of pocket 20% to go buy a replacement property. And the conversation sometimes would be, well, gee, I don't have the 20%. I say, okay, well, do you have the 40% to pay in tax? And it's pretty wild, like I said, because that closing would happen. We would just end up being assigned ownership of the property. We would not be receiving any cash. And really in this situation, what we're looking at is gain due to debt relief. And that phantom gain is the difference between the debt and the basis. If debt over basis, you've got phantom gain, you've got this decision to make. This is an example of just converting properties. We talked about 121, 1031, 1034, all those things earlier. I talked about the Housing Assistance Tax Act. But in this situation, what happens, these people got referred into us. They were selling a property, primary residence, roughly $3 million in gain. Their lawyers sent them to us. We told them to move out of the house. They did. They went and bought their dream home. They held the property for investment, and then after a year or so in their situation, they then sold the property, bought 24 different replacement properties, closed them all inside the 45 days because they didn't want to risk having a failed purchase, which would then have nullified, because they were working with the 95% rule. They had to close 95% of the aggregate value of all properties ID'd. So they went from $1 million tax to zero tax, got 24 investment properties, got the home that they really wanted. When the sale happened, they were entitled to the $500,000 exclusion. They 1031 the overage. So I think that's a win-win-win for them. This situation, this is the transaction where we're looking at conveyance of ownership and getting people where they want to go. And it's really hard for us to do improvement exchanges up and down the West Coast these days because it just takes so long. And we got to talk to our politicians because they all talk about, oh, we want affordable housing, all this and that. Then they all complain about it. Well, one, get your hand out of our pocket with respect to the charges associated with getting a shovel in the ground, and two, let us build. I mean, if I do a project in Texas or Florida, one of those places, it might be possible for the developer to walk into a planning department, walk out with a permit. We're up and down the West Coast, I can't get a shovel in the ground in a couple of years. So for us to do a normal improvement exchange is really tough these days. But we're doing, transaction where we do something called leasehold improvement exchanges. That's another presentation that that's an hour on its own, but that allows you to do some of this stuff. But in this situation, what happened is this broker had bought the property. He had gone out and gotten the planning engineering permitting set, and then we had one of his biggest clients was doing an exchange. So we knew that the broker ultimately wanted to be a partner in the project. So what happened is we had the broker sell his interest in the property to our client on a seller carry, gave us the ability to buy the property. We went vertical on that property since the permits were all issued, and built the property out to a level that satisfied our exchangor's needs. The broker that had put this whole thing together, he didn't have an interest in the real property at that point, but he did have a lien on that property. So fast forward after the appropriate seasoning period for our 1031 client, we then created a new limited liability company. The client, our exchangor, contributed his property into that, the improved property into that entity, and he received an interest in it attributable to the equity in the property. At the same time that happened, the broker contributed his seller finance, that note, and he received an interest attributable to the value of the note. Now the project was owned by our client, the exchangor, and the broker that had structured the whole thing initially, got everybody where they wanted to go. Now fast forward a few years, you go full cycle on it. So what happens is we now deed that property back out from the entity into a tenancy in common, and upon that future disposition, and this thing did go full cycle, the two parties had the ability to either sell and pay tax or do exchanges at will once again, since they were tenancy in common, and we eliminated the partnership interest. So that's just an example of what can be done with appropriate planning. That is it. If you are interested in more content, you got ideas for content, please don't hesitate to reach out to us. See more at 1031exchange.com. Please like and subscribe our stuff. It really helps us out. And the YouTube content, I think, is great. And it really covers a variety of topics. And I always sort of joke, well, gee, if it's not helping you out, at least it can, maybe help you fall asleep at some point, some night. But my name, once again, is David Moore, and I'm with Equity Advantage. And I want to thank you so much for spending the last hour and a half with me. And I look forward to talking with you soon. David Moore, Equity Advantage, 1031exchange.com. And this pack will be available if you would like a copy. Reach out to Seymour at 1031exchange.com. And happy 2026. Thank you. Bye-bye.